Crompton Greaves Electricals has reported an inline set of earnings for the September quarter. The lighting segment remains a drag with its revenue falling almost 11%. Let's discuss the number with the Managing Director Shantanu Khosla. So if you could give us the details how the performance has been for the ECD segment as well as for the lighting segment, and what may be the reason for the degrowth in the lighting segment.
Yeah, sure. Our ECD segment, which is our largest segment, has performed strongly with growth in double digits. All three segments, fans, pumps, and appliances of our ECD business has grown. We've grown market share, and importantly also in the challenging time, not only have we sustained growth, but we've also improved our gross margins by about 300 basis points on the ECD business, while market shares are also up. So this business, behind innovations, behind investment in advertising and strong distribution programs, continues to be robust and strong. The lighting segment continues to be challenging. One thing really this quarter about the lighting segment is a significant amount of the degrowth was driven by a reduction in EESL or government orders versus the base period. But even if I ignore that, the business is down a point or so, and it has been challenging, primarily driven by continued price erosion in a market which today is really hyper competitive. In fact, over this quarter we've seen a decline in pricing by about 15%. Within this, we have been focusing on the B2B segment and investing in capability and technology here. And this segment is beginning to respond because the B2B segment grew about 9%. But price erosion continues to remain a challenge looking forward.
How has the volume growth been, for your fans and the pump segment, and also, overall, for the ECD segment? What the volume growth numbers are looking like?
Really, the value growth in our ECD segment is largely volume driven. There is some amount of small amount of pricing in fans, but it's primarily volume driven. On lighting, again, if I ignore ESL, actually on our LED business, the volume growths have been very robust, and the value is the challenge given the price decline. For example, our panels and battens business, the volume growths were in excess of 30%.
So if you could give us, the overall outlook and also the margin outlook, going ahead into FY20 for your company.
Well, actually, if I look at PBT margins, our PBT margin has actually gone up slightly versus the base quarter of previous year, and we have consistently been growing our operating margins, and today we're probably the most profitable company in our industry from a margin point of view. Of course, when you look at it on an after-tax basis, there's a significant additional benefit of the reduced tax rate, which, for example, this quarter gets reflected in a PAT growth of 44% and record high PAT margins. But fundamentally, looking forward, our effective tax rate will come down from close to 36% to close to 26%, and that's what's reflected in the first half of this year, and we see that benefit moving forward. So margin progression we expect to continue to be industry leading and strong.
All right, so we'll leave it till there. Thanks for talking to BloombergQuint.
Thank you so much. Thank you.